Hey, what's up? It's Magda from Crypto Masters. In this video, I'm going to talk about the second reason why a Bitcoin ETF isn't a good idea. Namely, this time it's about the loss of trust that a Bitcoin ETF entails. If you haven't already watched the first reason for why a Bitcoin ETF isn't a good idea according to Andreas Antonopoulos, then go check out the previous video. So it's all about trust. And the point of Bitcoin is decentralization. So decentralization means that there is no central figure that we need to trust. It's actually all about not having to trust anyone. It's about being able to use software independently and being able to verify everything yourself. So what Bitcoin also does in essence, apart from giving you control of your money, is giving you control over who and how you trust. No more trusting that designated third party who for some reason we should see as the most trustworthy agent for making decisions about what is the best for your money. It represents an unheard of security model that is based on game theory and cryptography that simply doesn't need any form of trust. You know, trust but verify, right? Now, it's not in bank we trust, but in code we trust. You trust the incentives and the punishments. You trust proof of work and the Bitcoin awards. You can trust the platform because it's open to all. You just need to download the app to be able to start controlling your money and taking part in the network that decentralized trust. And Bitcoin is revolutionary exactly because of this, because it doesn't need clearing houses. And clearing houses are something that traditional financial institutions simply can't do without. The central reason of the creation of the first cryptocurrency, Bitcoin, is to make clearing houses obsolete. A clearinghouse boils down to being a trusted middleman that allows two parties that don't trust each other to do business anyway. You know, the clearinghouse provides an insurance in case one party defaults during the trade. And all of this comes, of course, with a considerable price tag that we have to cover. Now, with cryptocurrencies, that middleman is replaced by a blockchain, consensus algorithm, or a smart contract, if we're like talking Ethereum. So when a Bitcoin ETF is approved, clearinghouse services will be necessary. Now, clearinghouses aren't a bad thing by definition. They are meant to validate exchanges between banks. Fair enough. The major characteristic of a clearinghouse is that it cannot participate in the market, right? It must be a disinterested party. So as Antonopoulos calls it, it can't have skin in the game. An example of this is the New York Stock Exchange. So they are an independent party who has oversight over the goings-on of the market, but it is not a participant. So we're talking about the separation of concerns. This all sounds sweet, neutral, and fair, though it stops sounding all sweet, neutral, and fair when you replace the independent, disinterested party with 5 banks. Unlike the New York Stock Exchange, banks are active traders, so they have the skin in the game. How the hell are they supposed to ensure fair play when the temptation to cheat is so strong? Heard of market manipulation, price fixing? Heard of front running? These aren't sensational terms taken from Wolf of Wall Street. These are very current market manipulation techniques that are next to impossible to catch out. Why? Because these 5 banks are the clearinghouses themselves. Yeah, they're meant to be responsible to keep one another in check because they've created a consortium. But in reality, there are no real incentives to keep the consensus rules. Look at what happened back in 2008. The financial crisis could have been prevented if not for, and here I quote, just don't throw up. Undisclosed conflicts of interest, the failure of regulators, the credit rating agencies, and the market itself to rein in the excesses of Wall Street. Widespread failures in financial regulation and supervision. Dramatic failures of corporate governance and risk management at many systematically important financial institutions. A combination of excessive borrowing, risky investments, and lack of transparency by financial institutions. Ill preparation and inconsistent action by government that added to the uncertainty and panic, a systemic breakdown in accountability and ethics. And it's a scary list, but the sad thing is that it doesn't stop here. Like, what about the Libor scandal? So Libor was basically a series of fraudulent actions connected to the London interbank offered rate. So this scandal arose when it was discovered that banks were falsely inflating or deflating their rates so as to profit from trades or to give the impression that they were more creditworthy than they were. So what, you're saying trust these guys? I don't know about you, but I'm not feeling masochistic today. Trusting this consortium, aka clearinghouse, made up of the same market makers who have manipulated and compromised every market in history, that did everything to be non-transparent. Does this sound like it's fulfilling the criteria of efficiency, immutability, and security? I think not. So what does a separation of concerns look like in an ETF? Well, in order for the process of cryptocurrency purchasing to be easier, cheaper, more accessible to the public, we need a regulated infrastructure to be created around it. This means some big players getting approval from the Securities and Exchange Commission. Now, that's no small feat. This obviously means that major and recognized financial institutions need to get involved to build this infrastructure. This inevitably leads us to needing to trust these guys to no small degree. This is where the problems start. And just so you understand how this works, let me explain in a nutshell how an ETF is created. So the process begins with a prospective ETF manager, known as a sponsor. Some recent sponsors behind potential ETFs are VanEck, Solidex, the Winklevoss brothers, and surprise, surprise, even the Chicago Board of Exchange. So the process begins when a potential ETF manager files a plan with the US SEC to create an ETF. Now, once the plan is approved, the sponsor forms an agreement with, wait for it, an authorized agent, usually a market maker or large institutional investor who is empowered to create or redeem ETF shares. These authorized participants are traditionally large banks, such as the Bank of America, JP Morgan Chase, Goldman Sachs, and Morgan Stanley, among others. In some cases, the authorized participant and the sponsor are the same. Wasn't there meant to be something like the separation of concerns where if you were an interested party, say a shareholder, you couldn't at the same time control the infrastructure? Well, in an ETF, it looks like we're kind of going to have to trust the banks again. So what, is a Bitcoin ETF worth it? Are we not taking a step backward? Let me know in the comments below, and make sure to subscribe so you don't miss out on the next video about why a Bitcoin ETF will compromise, once again, what Bitcoin was meant to stand for. Thanks for listening.